Bitcoin and crypto have been disappointing because they really took it in the gut in mid-October and then kind of got hit again when, you're right, when the odds of a Fed cut dropped, Bitcoin fell. And then now that the odds have recovered of a cut, they haven't quite recovered.
First, the Fed is set to cut rates in December, and I think maybe more importantly, QT or quantitative tightening is ending. Now, QT started on April 2nd when the Fed began to taper its balance sheet and is ending now more than 3 years later. And as you can see on this chart, the Fed's balance sheet has shrunk dramatically. The last time the Fed ended its quantitative tightening program was in September 2019, and that program lasted about 18 months.
Bitcoin and the broader crypto market have faced challenges recently, with notable declines in mid-October, followed by further drops when expectations for a Federal Reserve rate cut diminished. Although the likelihood of a Fed cut has since increased, Bitcoin's price has not yet fully bounced back. This hesitation in recovery reflects broader market uncertainties, but signals remain that a turnaround could be on the horizon. The Federal Reserve is expected to cut interest rates in December, a move that often supports asset prices by making borrowing cheaper and encouraging investment. More crucially, the Fed's quantitative tightening, QT policy, which started in April 2022 by reducing its balance sheet, is coming to an end. This process has significantly shrunk the Fed's balance sheet over the past 3 years. The conclusion of QT is important because it typically eases liquidity conditions in the market. The last time QT concluded was in September 2019, after about 18 months, and this event preceded a sharp rally in stocks. In a recent interview, Tom Lee emphasized the significance of these developments. He pointed out that the S&P 500 surged approximately 17% in the weeks following the end of QT in 2019, suggesting a similar boost could be possible now. Tom Lee also noted healthy economic demand, the resolution of government shutdown-related data blackouts, and a seasonal tendency for December to be strong, all factors that can support stock market gains. These macro shifts, alongside improving Fed policy signals, could help Bitcoin and other risk assets regain traction in the coming months. Let's dive into the key takeaways from Tom Lee's insightful market analysis. To ensure you never miss our deep dive content, be sure to like this video, subscribe to the channel, and hit that notification bell. Thanks for tuning in. Enjoy the rest of the video.
But you still bullish on crypto and stocks going into year end?
I am. I think the biggest tailwind that's going to emerge in the next couple of weeks is around the central bank. The Fed is set to cut in December, but also today is the day that quantitative tightening ends. And as you know, the Fed's been shrinking its balance sheet since April 2022. It's been a pretty big headwind for market liquidity. The last time we had an end to QT, quantitative tightening, was September 2019. And if you look back at that period, the markets really responded well. I think within 3 weeks rallied more than 17%. So I do think the timing of QT ending, which is now essentially QE starting, and the Fed, and at a time when November kind of was topsy-turvy, so I think people got cautious, but now have to performance chase, and then you have a really typically a seasonal tailwind. So I'm pretty bullish into December, even with maybe the first day being rocky. I mean, I'd say that the shutdown put a blackout on data, and I think that created a bit of anxiety because, you know, markets like visibility. But to me, the fact that claims have been behaving and the September jobs report kind of showed a bit of a recovery. I think the labor market's probably holding fine, but the Fed doesn't want that to worsen. But I think the inflation story has actually weakened a lot. So to me, the Fed would be cutting for the right reasons, which is as they look at the next 12 months, the tariff inflation impacts are fading, but there's risk on the job market. So, I mean, I think it's cutting for the right reason, which is, you know, real rates are tightening if they don't cut. I think there was a bit of soul searching, Becky, in November, because we know leverage rose. And we know there was deleveraging in some markets like crypto, and we know margin debt's high. And I think that there was essentially a reset in November because the market had a 6% decline, but the AI stocks and the meme names and a lot of other names fell even more. So I think that position reset has been healthy. And I think many fund managers we talked to in November, in the midst of all that, kind of threw in the towel, thought the rest of the year was sort of a write-off. And now if December is strong, there's going to be a bit of performance chasing. And I think that's what you should typically expect in the final weeks of the year.
Now, everybody, you're sure that they're going to cut now. There was a time where we thought they weren't going to cut. What do we get for going back to cutting mode?
Yeah, I mean, Bitcoin and crypto have been disappointing because they really took it in the gut in mid-October and then kind of got hit again when, you're right, when the odds of a Fed cut dropped, Bitcoin fell. And then now that the odds have recovered of a cut, they haven't quite recovered. I mean, I think that's still the lingering effects of that deleveraging that happened on October 10th. It's not that different than the wipeout that happened in 2022 with FTX. That took 8 weeks. So we're kind of emerging from that. That's 7 weeks in the rearview mirror. So maybe in another week or two, I think crypto has fully washed out, and that's when it starts to participate. I mean, 7,000 is only 2% for S&P. From here, I think 5% or maybe even 10% is possible in December. So I think a 7,200, 7,300 is likely for S&P.
Ask you not to do that. You're giving me a target and a time. Don't. It's not good for your career. Don't do that. You're going to be wrong one of these times. But you don't care, do you? You've been right enough.
Well, I'm just looking at probabilities. But you're right. We've been wrong plenty of times, Joe. So I'm okay being wrong too.
Okay. I never have been, really. I don't think so. That would be a big shocker. It does. It happens to all of us. How about Bitcoin? Would you think you'd be happy with 100 if it got back by the end of December, wouldn't you?
Yeah. In fact, I think it was looking good, like you said, over the weekend, and then we got a decline. Sorry. Maybe because the Bank of Japan looks hawkish. Yeah. But I don't think the 4-year cycle. I don't think the Bitcoin high is in place. But you're right. We were too optimistic about this happening by December. But I do think Bitcoin can make an all-time high by the end of January. So I don't think we should think the highs are in place for Bitcoin or Ethereum or crypto. So a lot of it's going to depend on equities recovering, which we expect it to, and that helps the animal spirits. And I think a new Fed chair will help. And we have, as Becky said, when people got worried about a hawkish Fed, that kind of hurts the discount models, the discounted cash flow models like AI models, but it hurts crypto models too. So if we have a dovish Fed, that's really a tailwind.
A Fed that's too dovish scares the markets because they're worried about inflation.
Yes. The markets don't want the Fed to lose credibility. And the bond market will kind of protest if the Fed is too dovish. But I think when I look at Fed fund futures, especially implied inflation, the bond market's more dovish than the Fed. So it looks like the Fed is behind, and that's why I think cuts are necessary.
The Fed is ending quantitative tightening this month, reversing a policy that has reduced market liquidity since April 2022. This change is expected to improve market conditions, as similar pauses in tightening in 2019 led to significant market rallies within weeks. Alongside this, the Fed plans to cut interest rates in December, responding to weakening inflation and risks in the labor market. Inflation pressures, including from tariffs, are easing, making rate cuts a timely move to support the economy. November saw increased market volatility and deleveraging, particularly in sectors such as crypto and AI stocks, with some fund managers temporarily losing confidence. However, this pullback is seen as a healthy reset, similar to prior market corrections. According to Tom Lee, as the market digests these changes, performance chasing could drive gains entering December, which often benefits from seasonal tailwinds. Bitcoin, despite recent dips, may not have peaked yet, with potential for new highs early next year if broader equities recover and the Fed adopts a more dovish stance. The bond market currently expects more easing than the Fed signals, supporting the likelihood of upcoming rate cuts.
So let's talk about the macro and 6 reasons why I expect stocks to rally in December. First, the Fed is set to cut rates in December, and I think maybe more importantly, QT or quantitative tightening is ending. Now, QT started on April 2nd when the Fed began to taper its balance sheet, and that is ending now more than 3 years later. And as you can see on this chart, the Fed's balance sheet has shrunk dramatically. The last time the Fed ended its quantitative tightening program was in September 2019, and that program lasted about 18 months. But let's look at the S&P 500 during that period of time. When QT ended on September 19th, okay, you can see the S&P up until that point was in a range bound, in fact, had a pretty nasty correction, but then quickly gained around 17% over 16 trading days. So it was significant for equities once QT ended. So that's something to keep in mind. Now, as far as the Fed taking action in December, I want to start with the Bank of Japan because it looks like the odds have shifted for the Bank of Japan to actually hike rates in December. 61% odds according to Polymarket. Now that contrasts with what the Fed's planning to do. Looking at Polymarket, again, market-based odds, an 89% chance the Fed cuts in December. So we're really talking about two central banks pursuing different paths. But again, for U.S. equities, it's really what the Fed's going to do. And finally, with regard to the Fed, President Trump just recently said he knows who he's going to pick as Fed chair and announce it soon. I'm going to guess it's going to come around or slightly after the FOMC rate decision in December. But markets are anticipating this to be Kevin Hassett. Number two reason for expecting a rally in December is that the economy is still healthy. There's still plenty of pent-up demand, and the ISM manufacturing has been below 50 for 3 years. Now that is going to be updated this week for November, and housing has plenty of pent-up demand. Number three, the government shutdown's over. We've had a blackout of economic data, and that markets don't like the lack of information. That's going to have a restoration of visibility. Number four, there's performance chasing. Investors are off sides in November because a lot of funds actually threw in the towel. They just thought the markets made the highs for the year. And already 2025 was the worst year for fund managers, with 78% trailing their benchmark through October. Number five, stocks got oversold. And I think especially when you look at RSI. This is daily RSI for the S&P year to date. And the daily RSI fell to 35 in November. That's the most oversold it got since the April tariff lows. And as you can see on this chart, once you made those lows on the RSI in April, market began to rally pretty sharply. And lastly, it's seasonal. December usually finishes strong. And given the pullback in November, I actually think December is shaping up to be a good year. Good month. And as far as macro data this week, there's a lot. The ISM manufacturing for November comes out on Monday. On Wednesday, November ISM services. And on Friday, we get a trio of data, but the one the market's probably going to focus on most is core PCE for September. And there are some companies reporting this week that are granny shots. CrowdStrike on the large cap side. And there are 5 mid cap grannies reporting: MongoDB, Pure Storage, UiPath, Donaldson and Company, and Samsara. Most of these are AI related stocks. And as for individual stock performance, let me just highlight the top 5 performers for Granny and Granny Income were Robinhood, Broadcom, SoFi Technologies, Arista Networks, and Tesla. And these are basically AI related names. The bottom 5 are Costco, S&P Global, TJX, NVIDIA, and Deere. On the SMID side, the top 5 performers were Lumentum, Riot Platforms, Bloom Energy, IonQ, and SoFi Technologies. And the bottom 5 are East West Bancorp, Weatherford International, Watts Water Technologies, Pegasus Systems, and Qualys. And as far as themes go, I want to highlight the 3 that contributed most to the relative performance. The first are millennials. As you can see, it was a bigger contributor to the SMID cap portfolio. The second is the global labor shortage and AI related stocks. And the third are energy and cybersecurity related names.
Tom Lee pointed out 6 reasons to expect a rally in stocks this December, focusing on the S&P 500's past reaction to quantitative tightening, QT. He pointed out that when QT ended in September 2019, the S&P 500 quickly gained around 17% over 16 trading days after a sharp correction and period of sideways movement. He noted that the current environment has a similar dynamic, with the Fed expected to cut rates in December. This is a move the market has priced in with an 89% probability, contrasting with the Bank of Japan, where there's around a 61% chance of a rate hike. Despite these differing central bank paths, Lee emphasized that the Fed's decisions remain critical for U.S. stocks. He also explained that the economy remains healthy with strong pent-up demand, particularly in housing, and that the recent government shutdown ended a blackout period for economic data, restoring visibility which markets prefer. Lee mentioned that many investors gave up in November after poor fund performance, creating room for performance chasing to push prices up. Stocks also appeared oversold, with the S&P 500's daily RSI falling to levels last seen during previous market low points, which historically led to rallies. He added that December's usual seasonal strength could further support gains given the market pullback in November. Regarding the week ahead, Tom Lee talked about key updates including ISM manufacturing and services data, as well as core PCE inflation figures. He also enumerated notable earnings reports from companies like CrowdStrike and MongoDB, which relate to AI themes. Performance in AI, millennials-driven investments, and sectors such as energy and cybersecurity were mentioned as key contributors to recent market movements, showing how specific themes influence relative stock performance. To wrap this up, how do you think the end of quantitative tightening and the Fed's upcoming rate cut will impact Bitcoin and the broader stock market in December? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.